Alright, hello guys. Today I'm going to be trying to do something very inadvisable, which is make testable predictions on the internet. And today's topic is, what will the AI market top look like? So the first step is defining what our cycle is, because there's a lot of different things that cause recessions. You have external shocks, like you saw with the oil shock in 1973 and the pandemic in 2020. You have rate-driven cycles, like you saw in 1937. That was the recession within a depression. And then 1981, the Volcker shock, and 2022, the hiking cycle. And then you have debt and leverage and capex cycles. So usually capex cycles are cycles as well. But you'll notice not all capex results in a crash. This 2015 was shale capex. It was quite big, but it didn't result in a crash because what ended up happening is it crashed the price of oil, which was good for the overall economy. And then 2000 resulted in a pretty mild recession, but the rest of these are, these are the three biggest, worst crashes in American history. So that's not a great sign. And then this is probably the fifth worst crash in American history. And this was not caused by a capex cycle. This is caused by leverage and debt. And then in the background, you have America is going into a currency crisis, and this is like very slow moving. It's not going to cause any crash, but it's definitely going to factor in to what ends up happening. And here's some historical parallels, which we're going to get into in the next slide. So I wanted to look at only superpowers that had currency problems, just to see, what happened and what we could learn from history. And the first two are, you have a coin that has very high metal content, and then over time that metal content is debased. And both times were successful. And what they did was they just made a new coin. Queen Elizabeth, she confiscated everyone's coins, said they were worth a quarter of what they were the face value was, and then she smelted them down and gave them back at high purity, and it worked. It worked. The Elizabethan age was very prosperous. The Rome story is a little less good. They basically made two systems. They kept the denarii, which was completely worthless essentially, but they made a new coin, the gold solidus, and that coin actually did maintain high metal content, and it was good for the people that had it, which is mostly military and people in the East, where they the western half of the Roman Empire didn't do so well, and they were prominently using denarii. And then the most interesting example is this example in 1557. And what makes it interesting is a couple things. It very closely parallels what's happening today in the situation in America, where you have this very, very wealthy country, a global superpower, Spain, and they have a huge amount of money from their expansion into the Americas. And this huge increase in the money supply causes domestic inflation, and they were funding wars. So they burned through this huge amount of money, and they were servicing debt at very high rates, and it was taking up essentially the entire budget. And the leader of Spain declared bankruptcy. He took all the high interest rates, put them into low interest rates, and it didn't really work. They kept a high metal content, unlike these. These were inherently devalued or debased. The metal content in Spain was high, but the problem was they relied on other countries' imports, right? Their manufacturing base got hollowed out because they were a global superpower. They ran a huge trade deficit, just like America. They projected military power, just like America, and these combine to essentially drain, the royal coffers, and led to a country that was broke. It defaulted multiple times, and it had inflation and hyperinflation. And it was a superpower, right? This is not a middling country. And then in 1789, the French created a fiat system, and the French were also a superpower. They wanted to fund their war, and in 6 years, the currency lost 99.9% of its value, and Napoleon came to power. He reestablished a hard currency, and he was very pro-fiscal discipline, and he instituted a national bank as well. And in 1991, USSR collapsed, and they tried this, that they were suffering from hyperinflation and inflation because the government was printing more than it was creating. And in order to fix that, they tried this thing called the Pavlov reform, where they basically tried to pull a Queen Elizabeth, where they said they were going to confiscate all this money, and this is hopefully intended to curb inflation. But the problem is Queen Elizabeth, one, she fundamentally solved the problem. The problem was debasement, and she took the debased currency and created a non-debased currency, where this did not solve the problem because the government was still printing massive amounts of money, and they didn't even confiscate anywhere near enough, only 18% of their goal. So it didn't work at all. It pissed off a huge amount of families that just essentially were stolen from the government, and the USSR collapsed. So what does this mean for America? So the first graph I want to look at is this graph. And this is the S&P divided by the M2 money supply. This is a crazy graph because, as you can see, the dot-com peak is where we're at today. So what that means is, in real terms, in terms of the money supply, only now, after 26 years, has equities recovered to where they were in 2000. And there's been a huge amount of printing. You can see in 2008 there was a huge drop, in 2020 there was a big drop, and in 2000 there was a big drop. So in real terms, currency is losing value rapidly. And here's a lifespan of fiat currencies. We have the American dollar, which has lost 97% of its value, and the pound sterling, which has lost 99.9%. And I think we talked about the franc at some point. The French assignat, that was the one that Napoleon abolished. 6 years, and that was a superpower too. And then there's a bunch of other interesting examples. And then this is a graph of how much the Federal Reserve is spending, or not the Federal Reserve, the government is spending on its debt as a percentage of GDP. And you can see we're about where we were in the 1990s. But this is a lot more dangerous than the 1990s because this was rate caused. This was self-inflicted. The government decided to do it to itself. And if they wanted to, they could cut rates and this number would rapidly fall. But we're not really in that environment. We're in this environment over here, where the problem is not caused by rates. The problem is caused by a huge amount of debt. This is the last time when debt was close to when it is today. And you can see that decline is much less steep than it was going into 2000. And we're not situated to decline. If you look at this graph, so this is deficits versus surpluses. And the interesting thing is there's a surplus here in 2000, and that's no coincidence. We're going to be talking about CapEx booms this whole presentation, and this is a CapEx boom. And you can also see another CapEx boom right here, the shale boom. And these CapEx booms have a huge impact in terms of government surpluses and helping out the government balance sheet, because there's a huge amount of money coming in from capital gains tax and investments, and it's just a lot easier to run a surplus during a CapEx boom. But I want you to look at where we're at. We're at 2025, 2026. You literally cannot see AI. We're spending more and more and more and more. We're projected to spend 10%, increase the deficit by 10% this year. So, I mean, this is like a runaway train. But like I said, it's not going to cause the crisis, but it will come into play if a crisis happens, because we're getting close to being out of runway. All right, so these are the leading indicators that I think are most important to look at in relation to the AI potential crash. So we have credit spreads, upstream supplier prices, market breadth, oil prices, long and short-term rates, and housing. And the only one I'm going to talk about on this side is market breadth. Market breadth is currently at 60 to 80%, depends on the index. If you're looking at the S&P 500, it's higher. If you're looking at the broad market, it's lower. This is very strong. And in all cases that I looked at in history, you can't have a market crash with this level of market breadth. It needs to deteriorate first. So that's one thing that I'm carefully watching to see if it deteriorates. Deterioration to the level it needs to deteriorate to facilitate a crash usually takes between 1 to 9 months. So oil's an external shock. What to say about oil? It's crazy. Price in oil is not matching reality. And that's most closely illustrated by this bottom left graph, where you have the refined products, diesel and gasoline, going much higher, and WTI crude oil not going higher. And part of the reason for this is WTI is fundamentally paper. It isn't a real product. It's a paper product that can be manipulated. And diesel and gasoline are molecules. They're not paper. They cannot be manipulated. They are what they are. And the government, through various means, through releasing massive historic SPR releases, through direct intervention, which they haven't admitted to, but seems very likely if you look at the price action, direct intervention in oil markets. And the government has a huge incentive to keep oil prices down. And they're doing everything that they can to keep oil prices down. But the fundamental reality is that we're in the biggest shortage in history, and we're very close to global operational stress levels. At 7.6 billion barrels, we're at 7.9, and we're losing 2.2 million a day. And Some of this would the total loss is 9 to 15 million barrels per day, but a lot of this is being covered by demand destruction, specifically in Asian markets. So if you look at this graph over here, what you'll see is that in every major recession, you have a peaking in oil prices. And the oil isn't causing the recession, but it is related to the recession. It makes it worse, and it can make it trigger earlier than it otherwise would have. And this is roughly my estimate for the shortening of the timeline if oil were to break out. Like if you would see a WTI go over 100, that would take the base case timeline and make it 3 to 6 months shorter. So rates, let's talk about rates a little bit. So rates don't affect the underlying reality of the bubble, but they do, like oil, affect the timeline. Right, the bubble is caused by a huge amount of investment, so much investment that there just by nature has to be overinvestment. And that overinvestment is only revealed, at a later date. But that date is kind of undefined, and it can be shifted based on oil and rates. So here I have some calculations for rates. Important to know that long-term rates are historically the highest they've been in like 20 years. Not high as the Volcker shock, but look, the government can't afford these types of rates, right? If the government were to take these types of rates, going back to this, we would not be spending 3% of GDP. We would be spending like 10% of GDP just on servicing debt. So to compare these rates to this environment is just, it misses the mark by so far, because this is fundamentally impossible. And if we tried to do this, it would immediately bankrupt our country. Anyway, so here we have probably the most important graph in the slideshow. I'm going to let you read it, but basically I'm interested in 4 different capex booms. We have the Great Depression, which was fundamentally caused by an electrification and radio boom. This is the biggest one on the list in terms of percentage GDP invested. And then we have AI. AI is the second biggest in terms of percentage GDP invested. And then you have internet, which is 3rd biggest. And then you have shale, which is 4th biggest. So these are things that all trigger during a capex boom. And free cash flow triggered in these dates, and then these dates, and then these dates, and then it has triggered. It's interesting to note that the free cash flow burn is much lower as a percent than in these booms. And that's because these hyperscalers are legacy businesses that are, cash cows. They have a huge balance sheet. And these were not. This was the biggest. These companies were also mostly legacy. So it's the most comparable. And it got a little bit higher than current levels. But it's just not really possible for companies to burn 120 to 150%. Because 120 or to 200% of Google is not the same as 120 to 200% of some random, shale company you've never heard of, or WorldCom, or Pets.com, right? There's no comparing those two companies. So these are very high levels just for the size of the company involved. If you look at the random no-name companies like NeoClouds, they're burning very high levels similar to this. So shift to heavy debt financing, that happens a few years out. We're going to go over this again in a graph. That's already happened, and it continues to happen. Just recently, NVIDIA announced a 500 billion deal of, essentially circular financing. Unit spot price deflation. This happens potentially very close. Like in the shale, it literally happened on the peak. The peak was on my birthday, June 23rd, in 2014, and it happened then because oil companies are very responsive to the price of oil. So when oil starts to go down, they go down as well. These happened. There was a little more of a lag. It's already happened. As token prices have dropped like 90%, and rates of rental have dropped, by more than half, which is important because you have a lot of these companies like SpaceX and Meta that are trying to pivot towards offering compute, but the compute costs are already starting to go down, and this is really bad because if you look at these, these are technologies that fundamentally last a really long time. This is probably the most similar because, oil, a specific oil plant has a very rapid depreciation rate, similar to GPUs. But these, essentially, from the perspective of, our depreciation rates for AI, they don't depreciate. This lasts, like 40 years. This lasts, we're still using fiber that we laid in .com. But this depreciates very quickly. So the two things that haven't triggered are are credit spreads. Credit spreads are not flashing a warning sign. But this happens potentially like right during the crash. Like, okay, this happened 6 months before the crash. This happened literally potentially March. That's the month of the peak. And this happened after the crash. So there's no guarantee that this will necessarily happen before the peak. It happened after the peak in 2014. Upstream equipment supplier peak. So this is, you start to see a decline. Let's say you're looking at TSMC monthly reports, and you're starting to see a decline of orders. This peaked after the crisis. Not after the crisis, but after the peak. And this peaked as well. Lucent peaked before, but Cisco peaked during, and Nortel peaked after. And this one, we have about 3 months of leeway before the peak. So, for a lot of the modern ones, they peaked beforehand. So these could trigger before the market peaks, puts in a new high before going down. But it's not guaranteed, right? And markets have a tendency to get faster as things get more modern and traders have access to more information. So, we're in a type of world that's very different from 1929, where people just have access to a lot more information and a lot more accurate information. So you might not see that 3-month lag time. It might be more likely that you see this, where the stock market peak predates the peak in orders, or like this, where the stock market peak predates the peak in orders. Okay, so let's look at housing. So one of the interesting thing is you had a housing boom in the 1920s, starting in 1920, and then it busted in 1925. And this had an interesting effect on the stock market, where instead of causing it to crash, it happened right at the beginning of a CapEx cycle. And what this did is money rotated out of housing, and into the capex cycle. And then later in 1927, you have the Fed come in and cut rates because of the housing crash, which also led to inflating the bubble. So housing can paradoxically have an inflationary effect on the bubble, but it can also have a deflationary effect on the bubble. It depends on timing. Like if housing happened, instead of in 1925 it collapsed in 1928, we'd probably be looking at a much different sort of outcome, where it would potentially, as a guess, drag the market down before October 1929. So if I look at housing is in decline. It's just a fact. Not a steep decline, but definitely a decline. It's been declining for 4 years. And the amount of buyers has been declining for 4 years, and sellers is picking up. And there's a huge gap between sellers and buyers. So it's not a great sign, but it's also not a housing cycle. But the underlying American economy is probably not as strong as it would ideally be, and that's visible in this data. So the US usually lags the world in terms of market crashes, usually by 2 to 8 months. We saw this in the GFC, where there were big problems in the euro before that. We saw this in telecom. We saw this in most crashes, most recessions that are not event driven. So we didn't see this in 2020, for example, because that was caused, everything went down at the same time. Same thing for the oil shock in 1973. Didn't really see that because everything went down because of the oil shock. But normally, the US lags the rest of the world. And that lag is pretty big. So what is the rest of the world doing? Well, it's not great. Kospi has crashed. And this crash is unprecedented. It fell 40% in 1 month. This never happened, ever. The only market crash that's even comparable is Black Monday, but it's a little different because the market crashed faster, I think 33% in a week, 7 trading days, but it didn't get all the way down to 40%. I mean, 40% is a huge correction. It's triple the speed of the COVID crash at the same level of drawdown. That's insane. We have big risks in the yen. You can see the government is trying to intervene. That's what these sharp downward slopes are. This is the Japan and the US, the last one. It's not working. The yen is about 160, which is the danger zone. It's not working. And this is important for the yen carry trade. It's important for Japan in general, who has a very high debt load, and their yields have been rising, so they can't afford this, right? Japan has 250% debt to GDP. They have a lot of assets, 140% of 150% of GDP in assets, but Japan can't really afford these rates to go much higher because of their huge debt load, and that's why their currency is weakening. And then we had some really interesting stuff happening in China. So China has had this huge housing crash starting in 2018, going all the way to the present day. And their economy, their internal economy is in contraction. And that's partly why they were able to cut their oil imports so drastically, by an unprecedented amount. And Hormuz didn't, blow up in all our faces because they cut their oil imports by something I'm not quite sure, but it was 6 million barrels per day, I think, around there, which cushioned a lot of the 9 to 15 million barrels per day disruption. So China is in this weird state where their internal economy is not doing well, and they're exporting a huge amount. And this has happened in history before. It happened specifically in the railroads, where you have the worst, well, maybe you could say it's the second worst, but one of the worst depressions in American history, caused by the railroads. And the U.S. started exporting. It's like a pressure release valve. You've got these factories that are producing, and what are you gonna do? You're gonna run them hot to try to offset the pain in the internal economy. So that happened in the railroads. It happened in Japan when they crashed in 1990, and it happened a few more times, but I'm forgetting the specifics. But this has happened before, where you have an internal economic collapse and then you have an export boom. And in the rest of the world, the rest of the West, things are not looking so great. Canada's in recession. All these countries are in, a stagflation environment. So there's definitely concerns in terms of a global outlook. Okay, so using all this information, what do I expect to happen? So this is the most dangerous part of the presentation, because what if I'm wrong? So I think that the S&P is not at its current peak. It will peak later, and I'm expecting about 1 to 8 months later. And the reason why I'm expecting 1 to 8 months is a couple reasons. One, you haven't seen these two things trigger, and most importantly, it's just not possible for the S&P to put in a peak at such a high level of market breadth. I mean, it hasn't been demonstrated to be possible by history. So maybe this will be the first time, but probably not. Probably we're going to see a deterioration in market breadth before that, and it's going to take a month or two. And my expectation is around October, and oil plays into that. Midterms play into that a little bit, and all the other factors that we've discussed play into that. Where I just think oil is probably going to start to go higher at some point, because the underlying reality is so bad. And I also think, Donald Trump, he's so motivated to keep everything held together before the midterms. And he's been very effective at holding things together that seem like they shouldn't be holdable together. But a big oil spike, I think, it might not happen, but I think it's likely. And that is why my timelines are a little shorter. Now, if a big oil spike doesn't happen, then the timelines go out a little longer. Same thing with rates. Like, if we don't get hikes, timeline goes out a little longer. But longer timelines means a bigger crash. So, it's good that, the timelines went longer, but it also means the bubble inflates even larger. And then once we put in a peak, I'm expecting at least, 1 to 3 years before we reach a trough. There have been times when it's been longer than that. I think in like 73, I want to say, where it was like 100 months. But that's rare, and normally it's about three years. Especially when you look at the current context, which is we have super elevated market valuations, like close to the highest they've ever been. In that context, it takes about 3 years. So S&P peak to trough drawdown of at least 30%. I wanted to say a higher number. I wanted to say, like, to be honest, I think it could be like upwards of 65%, just looking at the scale. That makes sense to me, 65%. But the problem is we're not operating in a free market economy. Like, you have the Fed, and the Fed is demonstrated that it's very willing to intervene in drastic ways, especially in COVID in 2008. So I fully expect the Fed to intervene in an extremely drastic way should there be a correction. And that is why my drawdown is so low. Because if the Fed intervenes in an extremely drastic way, one, it provides a lot of liquidity. It prevents the banking system from freezing up, which is what historically happens in the worst cases. In 2008, you had the banking system seize up. Same thing in 1873, same thing in 1929. All the biggest, worst crashes are caused by the banking system basically having a heart attack. And I don't think the Fed will let that happen. But that will come as a consequence of our national debt. And that will make this a lot worse. 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 So that's why I have such a conservative estimate for the peak to trough. But in reality, right, if we were in a free market environment with no manipulation from the Fed, I think that drawdown could get towards 70%. And then this is just what happens in the average. I think I had a previous video where the average drawdown in a sector with a capex boom is 84%. And it might be higher, to be honest, because this is such a big capex cycle. So yeah, I'm expecting about 80% drawdown. Maybe I could be conservative, say 70%. And then yes, what's going to happen the next decade? The next decade is going to have very, very high levels of inflation. And that's because we're in this cycle, this slow sovereign crisis cycle. And when you're in a sovereign crisis cycle, you can have crazy policy things happen. Like all the debt is just unilaterally transferred to a lower interest rate. Or, the Queen just freaking comes, loots all your coins, and says they're worth 1/4 as much. Or the government just steals all your money and completely changes the political system. So, it's hard to predict what's going to happen, but there could be very, what we would consider crazy policy responses. And then finally, I have a few graphs. So this is 1920 to 1940, the electrification boom. This was, a capex cycle that eventually resulted in over leverage, and the banks had a heart attack. And here you have operating cash flow reaches modern levels, and then yes, let's talk about, so we talked about the housing, right? So you have housing, and housing starts to roll over in 1925, and it leads to this downturn here, where people start freaking out about housing, and then they cut rates, so everything's okay, and this inflates the bubble to even bigger than it was. We probably would have seen a more mild peak had housing not happened. But you have credit spreads blowing out right before the final melt up. And then you have industrial production peaking. That's basically at the peak. It's at July, so yeah, like 3 months before the peak. Okay. So this is a very similar looking graph. We're going to see them together. This is 2000. So we have the Asian financial crisis, and then we have Russia default. The first, Thai unpegged, and then a bunch of Asian currencies had a bunch of trouble, and then eventually this is LTCM, long-term capital management, basically blowing up, and they were betting on Russia, and Russia had some, I think they had a default here due to the Asian financial crisis. And then you have 1997, CapEx crosses modern levels. Again, it's not really comparable because, it should be like here because, these are tiny companies instead of massive companies like we have today. And then we have the advanced decline line peaking. So this is related to market breadth, right? You can see this is definitely the highest, not the highest point. It had to go a lot higher, even with this crisis. And then you have credit spreads detaching here, and you have heavy debt financing. Heavy debt financing has already happened. This was bigger. I think it was 28%. 28% of all debt was telecom related, which is crazy. And then you have unit price deflation here. And finally, for our last trigger, upstream equipment supplier peaks, you have Lucent peaking here, but then you have Nortel peaking after the initial top. So right, that's not necessarily a guarantee that you're gonna spot the pop if you're just looking at upstream equipment suppliers. So here we have everything put together, and the graphs look very similar. These two graphs we just looked at. This is a Kospi, fastest crash in history, deepest crash. Not fastest, but a combination of extremely fast and extremely deep. And then this is 2020 with modern data overlaid. And I'm estimating, for the sake of this graph, 2 months. So I think that's going to put us in October, an October peak. And we could see, let me just make this as large as possible. We can see that CapEx, okay, let's start over here. So later in our cycle, we have the CapEx peaks. And then much earlier in our cycle, we have token prices drop and H100 GPU rentals drop. And then a little earlier in the cycle, we have private credit expansion and debt, basically huge amounts of debt. So these things are not happening at completely synchronized times during the cycle, right? These are estimates, and they're happening somewhere in this range. But like I said, there's no eventual guarantee that the last two things, upstream supplier and credit spreads, will signal before the market top. Now, they will probably signal before like this top, but this is a steep decline, and you might not necessarily want to be involved in that decline, but you might feel like it's worth it to eke out that last little bit of that spike. But just a warning, these things might not signal. Historically, they have signaled after, especially in shale, and both of them in shale signaled after, and then the ones that signaled when it was reliably signaling before, I mean, it was just a different time with a lot less information, and information just moved slower, and it was harder to gather and less accurate. And that's not the current environment that we're in. So my expectation is that these will probably peak after the market peaks, not before. So finally, we just have a collection of market tops. And what I want to point out about this is you have a top, and then you have a decline. And the decline is like 5 to 10%. And then you usually have a little bit of a bump. And then you have the steep decline. So this is 2008. You have a top, you have 5% decline, you have a bump, and then you have a massive drop. This is when Lehman Brothers went under. This is 1987. This is Black Monday. You have a top, you have a moderate decline, 5%, and then you have a huge drop. This is 2000. You have a peak, and then you have this one. It's more of a steady downtrend down. Same thing with this one. This is a steady downtrend with some peaks, lower highs, right? All these are marked with lower highs. We haven't put in a lower high yet, so right, there's still room to go up, as well as the background, the market breadth is very good. But yeah, this is just an interesting collection. All right, that's all I had for you today. Let me know what you guys think in the comments.